Good morning students, welcome back to today's class. Today we are going to see that accountancy chapter 5 accounting ratios. This is chapter number 10. Here we are going to discuss about that trade payable turnover ratio. Trade payable turnover ratio is showing that the relationship between total credit purchase and average trade payable. Means it is showing that when we purchase goods from our suppliers on a credit base, not on ready cash, but whenever we purchase from our suppliers on credit base, like that if we have more suppliers, if we are purchasing from more suppliers, the total amount we are calculating. Here also the total credit purchase amount we are calculating. That is why it is given that the formula is that net credit purchase upon average trade payable. So you understand that net credit purchase now? That means from our suppliers we purchase on credit basis. Like that, if from how many suppliers we are purchasing, the total we consider as that net credit purchase. And average trade payable means creditors, opening creditors plus bills payable plus closing creditors and bills payable upon 2. Got clear now that formula? Just like a trade receivable turnover ratio, but here is the difference. One is at a trade receivable and another is at a net amount of purchase. That much difference is there. There we and the trade receivable turnover ratio, we find out that net credit sale or credits revenue and trade receivable. But here we are considering that net credit purchase. That means money we need to pay to our suppliers. You got difference now? And other part is at average trade payable. Average trade payable we will get like opening creditors and bills payable plus closing creditors and bills receivable upon 2. Clear now? And here also you can see that if very low ratio is not good, that means two consideration may be there. One is that the suppliers are given a long time of credit allowance to us, means they are not collecting that money immediately from us. And another thing is that, another meaning is that we cannot assume that which is that, okay. Through this ratio we cannot identify which of that. The second one is that we make delay. You understand now? One is that the supplier can give us more credit period. We get that long time. Long time means this is not for that more than 1 year. Means that time is something extensive. Means 3 months. Normally you know that a few days only will get that credit period. Then only we consider that creditors. It will come under that current liability. But here you see that sometimes that the supplier can extend that time. Two possibilities are there. One is that the creditors, the suppliers extend that the time. That is why that ratio is very low. And another is that we are making delay. So if you imagine that if we received some money from somebody, that means we borrowed some money from somebody, then for returning that date will be informed. When we are borrowing some money, for example, you have some emergency. Ayush wants some emergency, then Ayush approached to Ashdod to get some amount. Then he said that okay, 500 rupees, and then 500 is given by that. Arthur said that okay, you give after 10 days, or they agreed that after 10 days that money will be returned to Arthur. But there you can see that two possibilities are. One is that Arthur extend that time. Arthur said that okay, after 10 days you no need of paying that. After 10 days you can take that 1 more month. Total 1.5 month. Or otherwise, that Ayush can make delay. That means 10 is agreed date. Even after 10 days, Ayush is not paying. Ayush is saying that next day. You understand? No? These two possibilities are there. But from this ratio, we cannot identify which of that. But anyhow, that is not a good for the business if we are making delay. Okay. That only is saying here, but we cannot find which of that. Because of any two reason, it may be low. That ratio can be low. But here we are finding out that what is that ratio. So here also we can solve one illustration. Through this you will understand that better. Calculate the trade payable turnover ratio from the following figures. Credit purchases during 2014-15, 12 lakhs. Here directly given that credit purchases 12 lakhs. Next is that creditors on 1/4/2014, that means beginning creditors is at 3 lakh. Beginning creditors or opening creditors is at 3 lakh. Next is at bills receivable. Beginning bills receivable, bills payable is at 1 lakh. This is beginning part, and the closing is that closing creditors are given. How much is that? 1 lakh 30,000. 30,000. Bills payable is also given 70,000. Very simple. Only here the things are given directly. Not much indirect way. All the questions you don't expect like this. One thing is that net credit purchase is given. That is 12 lakh. And opening trade payables is this. How much is that? 3 lakh plus 1 lakh? 4 lakh. And here closing. How much is that? 2 lakh. And now we are directly putting into that equation. Which is that equation? Trade payable turnover ratio. Turnover ratio is equal to net credit purchase upon average trade payable, no? Trade payable. Very simple only. In this question you can see that those things are given directly. That net credit purchase is directly given. This one, no? Upon 6 lakh. These two will not copy. And we need to take its average, no? Not only this, that is not 6 lakh. Here this is 6 lakh, and for this, in order to find this one formula is there. This two, that is, its total we have taken 4 lakh, and its total also we do. We add these two, we got that 6 lakh, and its average we need. How much is that? 3 lakh. So that 3 lakh we put here. 4 lakh. 4 lakh. Clear now? Answer right.